Very good morning. I think we welcome. 1 second. 1 second. Okay. Okay. Fine. Sorry. Good morning. Good morning to all. On behalf of the Kanchipura branch of SARC and CP Committee of Chengalpattu branch of SARC, we heartily welcome you all participants and CA members. Wonderful for this wonderful program, Decoding Direct Tax Amendment in Union Budget session. 1 second. And we welcome our chairman, CA Satya sir, and our managing committee, and also we welcome all our regional members, and we welcome Direct Tax Committee chairman, CA MGV sir, and we finally welcome our eminent speaker, CA Vivek Rajan sir, for this wonderful session. Now I request MGV sir to take over this and to give an introduction about our speakers. Thank you.
Thank you, Yuvamurthy. With respect to this decoding of amendments in the direct taxes, our eminent speaker above, I would like to.
Satya sir and our managing committee, and also we welcome
with respect to eminent speaker, I would like to introduce CAV Vivek Rajan. Of course, those who are attending the series of meetings, they are aware of him. So he is basically a fellow member of Chartered Accountant in practice, and he has more than 12 years of experience in the profession. And he has written many articles on legal matters, and one of his articles on audit report under the Companies Act published in September 2014 has been read and shared by many readers. And Vivek Rajan has been regular contributor to the articles published in the monthly bulletins of Chartered Accountant Study Circle, one of the oldest study circle in the city. His discussion paper on the Union Budget 16, 17, 18, and 19 has been well received and published in the Chartered Accountant Study Circle respective monthly bulletins also. And his discussion paper on Union Budget 18 and 19 was selected as a best article for both the years and 18 and 19. His discussion paper for the Finance Act 19 in the study circle was a 7-part monthly series that covered 100% of the amendments on direct taxation in a detailed manner. And he is one of the faculties of the Indirect Taxes Committee of the ICAI for GST also. And he is a proactive thinker and has the ability to appreciate aspects. And basically, he used to take all these direct tax to, just now before the meeting started, we just discussed, he used to take it to heart, the direct taxes. So we can all enjoy the meticulous amendments, whatever, in the finance bill. And for the first 3 sessions, he had covered all the amendments with respect to, actually he has covered this cryptocurrencies, virtual digital asset, and as well as the amendments with respect to this section 10.10.23c. And today session he is going to cover, of course earlier session he has covered all the trust exemptions. Today non-trust exemptions, like there is a non-trust amendments like section 14 to section 43b of the Income Tax Act. So now over to our speaker Vivek Rajan. Thank you.
Thank you, sir. Thank you, sir. Thank you, everyone. Very good morning. Welcome to everyone. Thank you for making it. It has been wonderful presenting here. And for those who have been attending from day one, we would have covered 3 sessions three sessions so far. And today it is the 4th session. And in this, today it is the 4th session. So in this scenario, initially we would like to start with the recap of part 1, part 2, and part 3. In the first session on 25th February 2022, we had dealt with cryptocurrency, mainly the amendments with respect to cryptocurrency, and a clarificatory amendment on slump sale. So first, with respect to slump sale, first the amendment with respect to slump sale, section 242C, it was a clarificatory amendment with retrospective effect. What was the amendment in short is, it is that the scope of the word slump sale was expanded to cover all forms of transfer under the scope by Finance Act 2021. So prior to that, slump sale included only transfer. Then after Finance Act 2021's amendment, slump sale was expanded to cover all forms of transfer under its scope. Inadvertently in Finance Act 2021, the last sentence, there was a word, there is a reference to the word sales instead of transfer. So that inadvertence they had rectified it with this amendment in Finance Bill 2022. So from now onwards, it is more of a clarificatory, as I said. Slump sale would include all the forms of transfer. The next of the amendments that we discussed was taxation of the virtual digital assets. In other words, cryptocurrencies, NFTs. This is with effect from 1st April 2022. Reference to the explanatory memorandum. The explanatory memorandum very categorically mentioned that virtual digital assets have gained tremendous popularity in the recent times, and the volumes of trading in digital assets have increased substantially. A market is getting created for the virtual digital assets. So the definition of virtual digital asset, section 247A, specifically defined what is a virtual digital asset. It is virtual digital assets mean any information or any code or any number or any token or any other item by whatever name called, generated through cryptographic means or other means. So what a virtual digital asset should do, it should provide a digital representation of value exchange with or without consideration. It should have a promise or representation of having inherent value. It should function as a store of value. It should be a unit of amount, including its use in any financial transaction or investment, but not limited to investment scheme. And it can be transferred, stored, or traded electronically. It should be a non-fungible token or any other token of similar nature by whatever name called. It can be any other digital asset as the central government may specify. So this is the definition of virtual digital asset as per the Finance Bill 2022. But in this definition, there are again few technical words which the Act has not defined. But the general definition that is available in the internet or in any dictionary with respect to these transactions are store of value. A store of value is an asset that maintains its value rather than depreciating, and non-fungible token. Non-fungible tokens are cryptographic assets on a blockchain with a unique identification code and metadata that distinguish from each other. At present, the term non-fungible token asset is not defined by the Act. Because of this uniqueness, non-fungible token has the potential to be used in several cases. I gave the example on the first day. This NFTs. Gave the example of entertainment industry catching up with this NFT. Popular movies, popular scenes of popular movies are being sold as NFTs. Indian cricketers are planning to sell NFTs of their moments in the cricketing field. And famous authors, lyricists, they are planning to create NFTs of their literary work. So this is basically an intangible item, which anyone who has an intangible item and anyone who feels that there is a market still to be exploited for this intangible item, yes, we can. They can go through this cryptographic means or NFTs. NFTs in future, it is going to, in my view, it is going to unleash itself everywhere. And in the first session also, we discussed that with respect to an NFT that is being sold today. For example, there is an intangible asset, the company is having an intangible asset, it is selling the NFT today. It will be revenue for that company, no doubt. But the cost with respect to that revenue, the government is very silent as to how to determine the cost with respect to certain scenarios. Of course, in the taxing section, the government is specifically saying that whatever is the income, you get the cost of acquisition can be claimed as a deduction and the balance amount is taxable. However, in certain cases, the cost, in my view, would be nil. For example, a company which has an intangible resource today, and with respect to creation of the intangible resource, the cost would have been claimed in the earlier years. And today there is an emerging market in the intangible, for that intangible asset. So practically speaking, the cost would be very nil. One particular revolving example I can just connect this. 10 years ago, back then, there are online platforms like Netflix, Amazon, were not that much there. They've evolved. It's a 10 years evolvement. So prior to 10 years, if you could see a movie would release in a theater, and from there 30 days or 60 days, it would be telecasted on the television. So from the industry perspective, what would happen those days is a television company would purchase the movie outright. That is, the television company would purchase the movie for telecasting in its satellite channel, and also it will purchase it in a wholesome way such that all the rights that can emanate from the future the particular company can enjoy that right. So these days, those days, if you could see a particular movie would release in a particular channel only with no digital mediums in those days. Now, if you could see any movie that is getting released, the digital version is getting released in either of the OTT versions like Netflix or Amazon or Hotstar, and the satellite rights are being sold to any of the top television channels like the Sun TV, Vijay TV, everyone. So the market is getting split. So in this aspect, the digital market has come up for the entertainment sector for the movies that was released long before. And these satellite television companies, they would have purchased these rights, and they would have purchased these rights from the production house, and that purchase cost they would have claimed it, say 10 years ago. If they had purchased it, they would have claimed it 10 years ago. But this digital right is a later evolvement, later development, and now they'll be utilizing this digital asset, and the revenue that they get from these digital rights, it is totally taxable, because in my view, all the cost with respect to that one, it has already been incurred in the earlier years. So in the similar way, tomorrow, if the revenue is going to come from an NFT, the cost would be virtually nil, because the cost would have been claimed in the earlier years. So basically, that is how the NFTs is going to evolve. Section 115 BBH talks about taxation of income from the virtual digital asset. Any income from the transfer of any virtual digital asset, it would be taxed at the rate of 30% of income. Income means sale proceeds minus cost of acquisition. Deductions, except cost of acquisition, no deduction or allowance or set off or any loss shall be allowed. Intra-year adjustment, loss from transfer of virtual digital asset was not allowed. Carry forward of loss from virtual digital asset was not allowed. Taxability of the transactions, a practical illustration we explained, whereby the sale consideration of Ethereum was 5 lakhs in a case, and the sale consideration of Dogecoin, one another form of cryptocurrency, was 2 lakhs. The purchase cost of Ethereum was 1 lakh. The purchase cost of Dogecoin is 3 lakhs. So in this scenario, the income will be 4 lakhs. Income will be 4 lakhs. Why? Because the Ethereum was purchased for 5 lakhs, and the cost of purchase of Ethereum was 1 lakh. The income will be 4 lakhs. The sale from the Dogecoin, it has resulted in loss of 1 lakh. That 1 lakh cannot be claimed anywhere. One another TDS section has been inserted for taxing of the income from virtual digital asset. That is with effect from 1st July 2022. The TDS section prescribes the deductor to be any person, including non-resident, and it prescribes the deductee to be any resident. And the rate of 1% is the rate at which TDS has to be deducted. TDS has to be deducted on swaps of cryptocurrency to rupee and cryptocurrency to cryptocurrency. TAN number is not required. There are exemptions for individuals and institutions. There are exemptions for companies in the as regards to reduction of TDS. As I said in that day, the present day trading in cryptocurrencies is being conducted through online platforms. So most of the online platforms are either run by corporates based out of India or corporates based out of foreign countries. Any transaction in crypto, they act as a mediator. I am purchasing crypto, I am selling in crypto. They are the persons who act as a mediator. They get my money and they transfer money to my account. So basically, it is the online platform that is doing this. So reduction of TDS, the respective online platform who is discharging the transactions should take it into their system, and they will have to give effect to the reduction of tax. And practically speaking, this 1% PDS, 1% PDS would take place. Complying with this 1% PDS would be of greater challenge, because multiple transactions take place on a single day with varying margins. So we also saw a practical illustration whereby Section 194, yes, an overriding effect with the 194O. Section 194O dealt with the scenario. Section 194O deals with the scenario where TDS has to be deducted on the transactions with respect to an e-commerce platform. So we saw that one too. And one particular evolvement that I wanted to say in this regard is, in this particular TDS section, the deduct, if you can please see the screen, the deductor is any other person, including non-resident. So deductor is a non-resident. So income, the non-residents generally in this category will be of two types: the non-resident who can trade in cryptocurrency, and the non-residents who run the trading platform. So for those non-residents who are running the trading platform, implications are different. The non-residents who are trading in cryptocurrency, they can always claim that the transaction took place in an offshore territory, and they can always take a resort under that offshore territory clause. So this, in my view, it is an indirect way of taxing the transfer, because the non-resident can very much claim my presence of establishment is elsewhere. And since cryptocurrency transactions are boundaryless, it can take place anywhere in the country through the internet, with servers located in any different country. So that being the case, the companies can claim that my offshore territory is elsewhere, and we cannot, our income does not emanate here. So we can see cases where those non-residents file an application under 195 for lower withholding of tax, or sometimes we can also see in the future that they will be claiming that we are not required to pay tax here because of the transaction, because the transactions emanate from an offshore territory. After making the first day's presentation, I also received one of queries from my friends. He also asked a specific example of how to tax this in case of offshore territory, because a company is based in India, it is a subsidiary of a Singapore company. So in that case, the transaction takes place, the substantial control of the transactions takes place in the Singapore, through the Singapore company. The server is located somewhere else. The Indian entity is just an entity that is giving effect to that transactions. So in those circumstances, how this taxability will be determined, how the TDS will be determined, well, we'll have to wait for the times to come, because in my view, the government has just started with taxation of cryptocurrencies, and all the other aspects with respect to cryptocurrencies, the practical methodologies in which it has to be implemented, we'll have to wait for the times to come. And lastly, with respect to crypto, is that a gifting of crypto is also becoming taxable once this finance bill gets approval of the president in the version it is. And as we speak, there are many platforms which allow you to purchase cryptocurrency, gift cryptocurrency to someone else. You can recharge your mobile phone with the cryptocurrency, and you can book your cash bill with cryptocurrency. And there are some online platforms which allow you to mortgage those cryptocurrencies and take a loan out of the cryptocurrencies. So as we speak, that is a event that is happening with respect to cryptocurrencies. So largely, this was the first day's session. So now I'm giving the recap of the second day's session. The second session, we saw largely amendments in section 10. The section 10 amendments we presented in splitting it into two parts: amendments with respect to 1023C and amendments relating to non-1023C amendments. The first of the amendments that we saw was amendments relating to IFSC. I initially explained what are the present benefits that an entity registered in the IFSC is getting. At present, IFSC, International Financial Services Center, the unit is located in the state of Gujarat, that is called as the GIFT City. So, an unit in the IFSC, at present, it is getting 100% tax exemption for 10 consecutive years out of 15 years, with the unit having the flexibility to select any 10 years out of the 15 years tax block. MAT or alternate minimum tax at 9% of book profit. MAT is not applicable to companies in IFSC opting for a new tax regime. Dividend paid to shareholders of the company located in GIFT IFSC to be taxed in the hands of the shareholders. These are the benefits that is available for the units in IFSC apart from the GST benefits. For the investors in IFSC, the interest income paid to non-residents is not taxable in case of monies lent to unit in IFSC, and the interest income on account of long-term bonds and rupee-denominated bonds listed on IFSC exchanges were taxable at a lower rate. And in some circumstances, the transfer of a capital asset was not regarded as a transfer. The explanatory memorandum categorically mentions that IFSC is a special economic zone that has been created with many tax benefits, obviously to attract investors and to promote the model of IFSC. So the explanatory memorandum mentions that in order to further incentivize operations from the IFSC, it is proposed to extend the exemptions under 1040, which was presently restricted to one particular form of share transactions. The amendment was in such a way that it extended the exemption from restricting to non-deliverable forward contracts till Finance Act 2021. with Finance Bill 2022, that exemption has been extended to income from transfer of offshore derivative instruments and income from transfer of over-the-counter derivatives. So when this session was taking place, prior to that day, in the stock exchanges of the GIFT IFSC, NSE National Stock Exchanges, they have a stock exchange in the GIFT IFSC. 8 major US companies started to trade their shares in the GIFT IFSC, like Netflix, Amazon, major US companies started to trade. I also remember telling that this trading of non-resident shares in the GIFT IFSC, this would become so popular such that in this financial year 21-22 or financial year 22-23 and going forward, while filing the individual tax returns, the individuals who are already trading in Indian company shares, we can see that they would be also trading in US company shares, because one major difference is that if you want to purchase an Indian company share, you will have to purchase one full share. That share value can be 10,000, 20,000 or IPO share, depends on the valuation. But with respect to US company share, you can purchase a fraction of a share. So for that fraction, a particular receipt is being given. So in the times to come, we can see many individuals who already trade in this shares, they would be trading in the foreign companies shares also. And to that extent, the annual information report that we can download from the income tax portal, to that extent, the information from the annual information report also would include the transactions from GIFT IFSC exchanges trades. So this was the exemption that was given. The next of the exemption that was given to the IFSC was royalty and interest from leasing of ship was not it's not going to be taxable. The initial, brief introduction about this is that already there is one existing section which says that royalty income, interest income from leasing of aircrafts to units in IFSC was not taxable. This is a very crucial amendment, because if you could see the airline industry, how it operates, majority of the airline industry, majority of the aircrafts that they operate is taken on lease, because purchasing of an aircraft involves huge outflow of cost, so it is taken on lease. That lease income which the non-resident lessor gets, it is exempt from tax. So consequent to this amendment, last year we saw that major aircraft companies set up their bases in Gujarat GIFT IFSC, and they got their licenses to operate from Gujarat GIFT IFSC. So this opened up the airline industry to that extent in GIFT IFSC. Now, Gujarat being in the coastal area, the same exemption is being given to the shipping industry. From Finance Bill 2022, any royalty or interest from leasing of ship would also be exempt from tax for the units in the IFSC, provided they start their operation before 31st March 2024. So just like how we saw aircraft companies setting up their bases in the GIFT IFSC, in the times to come, we can see the shipping companies setting up their bases in GIFT IFSC. The last of the amendments with respect to IFSC was exemption of income received from portfolio of securities. This was the amendments with respect to IFSC. Then there was one cluster of amendments with respect to withdrawal of exemptions for individuals working for government of foreign state in India. We saw that in section 10.8, 10.8A, 10.8B and 10.9. We saw that who is an individual who is assigned to duties in India. We also saw an individual who is a consultant who is assigned to duties in India, provided that agreement is being approved by the country foreign. Hello, am I audible, sir?
No, audible,
Yes, sir.
sir.
Yes.
Yes, sir.
Okay. We also saw section 10.8A, whereby remuneration or fees received by a consultant was here too it was exempt from tax. We also saw who is a consultant, what is the residential status of a consultant being an individual, if it is a foreign citizen, or the consultant can be an Indian citizen. If the consultant is not an individual, that person is required to be a non-resident. And we saw in section 10.8B that individual being an employee of the consultant, and the next section we saw the family members of the consultant who are receiving any income. So all these incomes were exempt from tax till Finance Act 2021. This Finance Bill 2022 has said that the explanatory rather has said that these exemptions have outlived their utility in this era of simplification of tax laws, and tax incentives are being phased out as a matter of stated policy of the government. So with this, the exemption that was earlier available has been phased out. Then we discussed about the amendments related to trust. The first of the amendment was, it again, we'll have to refer to the Taxation and Other Laws Relaxation Amendment of Certain Provisions Act 2020, whereby for the approval of registration or the cancellation of registration, the prescribed authority, the authority was the prescribed authority. In some cases, who was the prescribed authority, that mention was not given. In some cases, the prescribed authority was mentioned to be the principal commissioner or the commissioner. But specifically in 1023C 4, 5, 6, and 6A, which dealt with charitable institutions, hospitals, medical colleges, religious institutions, the prescribed authority was not mentioned. In other words, the words prescribed authority were there, but who was that prescribed authority, that mention was not there. So first of the amendment is with respect to 1023C 4, 5, 6, and 6A. For the words prescribed authority, the words principal commissioner or commissioner was substituted. The next of the amendment was amendment of 1023C, voluntary contribution received for renovation and repair of temples, mosques, gurudwara, churches, and other places of worship. The explanatory memorandum mentioned that donations were received for specific purposes for renovation of temples, mosques, and other places of worship. However, it is not clear if such donations are treated as corpus donations, are required to be applied or accumulated for a maximum period of 5 years. The amendment is proposed to bring clarity. So they have inserted explanation 1A, saying that any sum received by such trust as a voluntary contribution for the purpose of renovation or repair for such place of worship may be treated by such institution as forming part of the corpus of the trust. To that extent, if it forms part of corpus, to that extent, there is an exemption, and that particular income will not be subjected to tax. However, this is subject to the following conditions: that the trust or institution applies such corpus only for the purpose for which the voluntary contribution was made. The trust or institution does not apply such corpus for making contribution or donation to any other person. The trust or institution maintains such corpus as separately identifiable, and the trust or institution deposits or invests such corpus in the form and mode specified under 11.5. The next of the amendment was bringing consistency in the accumulation provisions. Existing scenario reference to explanatory memorandum. This accumulating provisions was there already in the already for the trust registered under section 11 and 12, but the lawmakers wanted to give the same benefit to the trust registered under 1023C 4, 5, and 6. So this has been brought out by bringing out amendments to that respective explanation. So explanation 3, existing scenario. Under the existing provision of the tax, a trust or institution is required to apply 85% of its income during the previous year. However, if it is not able to apply 85%, it is allowed to be accumulated subject to the provisions of section 11. However, there are no such specific provisions under 1023C of the Act, and the accumulated income, if not applied, shall be taxed in the 5th year itself. So this amendment was brought in to give that particular benefit to the trust covered under section 1023C 4, 5, and 6, 6A. And explanation 4 has been introduced in the Act to cover explanation 3, and explanation 5 is also introduced in the Act to cover explanation 4. So we saw what is the amendment in explanation 3. If the trust registered in 1023C, 85% of the income is not applied wholly and exclusive by the fund, trust, or institution, the income is accumulated or set apart, and such income is not included in the total income of the previous year, subject to the following conditions: that it furnishes a statement, the period of accumulation does not exceed 5 years, the money so accumulated is invested in modes of 11.5, the period of which the income could not be applied owing to an order of injection of court shall stand excluded. We saw explanation 4, whereby any income referred to in explanation 3. Explanation 3 confers a benefit subject to conditions. If the conditions are not satisfied, then explanation 4 kicks over. And in explanation 4 specifically mentions that an income referred to in explanation 3, if it is applied for specific purposes other than the objects of the fund or trust or institution, then it would be taxable in the previous year in which non-compliance occurs. Then explanation 4b mentioned that where that income referred to in explanation 3 ceases to remain invested or deposited in any other forms, it shall be deemed to be the income of such person in the previous year in which ceased to be remains invested. Explanation 4c said that if the amount is not utilized for the purpose it is so accumulated, then it will be taxed in the previous year. It will be the income of the person of the previous year being the last previous year for which it was set apart. And explanation 4D said that if the income specified in explanation 3, if the trust is making a donation of that, making donation out of that income to any other trust or institution, then it will be taxable. It shall be deemed to be the income of such a person for the previous year in which it was credited or paid to that fund or institution. Explanation 5 was also introduced. Explanation 5 said that notwithstanding anything contained in explanation 4, where due to circumstances beyond the control of the person, the effect of explanation 4 would not apply. So this example for this also we saw in the subsequent session that I will show it to you now. So practical illustrations for the explanation 3, 4, and 5 we had covered in the last session, which is also being summarized now. The trust was covered under 1023C, whose main objectives are providing free education and plantation of trees for upliftment of environment. They received an amount of 50 lakhs for plantation of tree samplings in September 2022. But according to its estimate, the plantation activity could extend up to March 2025 with rupees 5 lakhs getting applied in March 2023, 25 lakhs in financial year 23-24 and 20 lakhs in financial year 24-25. So what happens in the following years? In financial year 22-23, the trust furnishes a statement to the AO stating that the purpose of accumulation, that extensive plantation activity is there and the follow-up has to be taken place for the plantation activity. So a sum of 5 lakhs only would be getting applied in the year ending March 2023. A sum of 45 lakhs is planned to be accumulated for a period of 12 months, and that sum of 45 lakhs is planned to be invested in a post office savings bank. So having made all these disclosures to the AO, the amount taxable for the financial year 22-23 would be nil. For the financial year 23-24, the trust would again furnish a statement to the AO. It is basically an updated statement saying that the amount of accumulation has come down to 20 lakhs and the period of accumulation is 12 lakhs. Unspent amount lying in the post office savings banks is 20 lakhs. The amount taxable for financial 23-24 was nil. Financial year 24-25. So it's explanation 4A. I refer to this particular scenario where explanation 4A, this particular clause, this is an example for explanation 4A. Explanation 4A says that if the income referred to in explanation 3 is applied for purposes other than wholly and exclusively to the objects of the fund, trust, or institution, it shall be deemed to be the income of such person for the previous year in which non-compliance occurs. So in financial year 24-25, if the trust fails to apply the funds received for specified purpose and spends the same on administrative purpose and transfers the money to person specified under section 13, if that happens, then the amount taxable for financial year 2024-25 would be rupees 20 lakhs. Example for explanation B or 4B was also given. If the trust withdraws the money from post office savings banks and retains it in financial year 24-25 and it's not spending or applying it for any charitable purpose, in that case, the entire amount will be taxable. Example for explanation 4C was also given where the trust spends only 15 lakhs in financial year 2025 and the balance 5 lakhs remains to be applied. In that case, amount taxable in financial year 24-25 was 5 lakhs. Last of the explanation 4B, the trust transfers a sum of 5 lakhs to another hospital for treatment of cancer for a patient. In that case too, amount taxable in financial year 24-25 was 5 lakhs. I remember saying here is that this is a very strong amendment. The practical scenario, there are genuine trusts who require donation, and there are some trusts which help other trusts. So by virtue of this amendment, if that donation to another trust for genuine cases, if that is going to be taxed, then it will be of very serious implications to both the charitable organization and who is donating it and charitable organization who is receiving it. Then we saw the example with respect to explanation 5. Explanation 5, that in financial year 2025, due to a pandemic and the consequential lockdown, the trust could not apply the balance 20 lakhs. The trust makes an application to the AO citing that pandemic and further mentions that it would spend the balance amount on education of children instead of planting of trees. Assuming that the AO approves this, because in explanation 5, they has to approve an application, the reason stated by the entity should be beyond the control of the entity. So the pandemic being beyond the control of the entity, the trust makes an application in saying that instead of one particular, we are planting trees and also providing education to children. Due to this pandemic, we will be spending only on the education of children instead of planting trees, a sum of 20 lakhs. For the balance 5 lakhs, the trust plans to transfer the amount to some other trust who is affected by the pandemic. For the financial year 24-25, subject to explanation 5, an amount of 5 lakhs should be taxable. In other words, the amount that the trust is giving as donation to another trust would be taxable. The amount that the trust is applying for any other purpose would not be taxable because it is beyond the control of the entity. Then the amendments that we saw was the replacement of the 15th proviso, where the reference to the principal commissioner or commissioner for cancellation of registration of approval. The explanatory memorandum, in short, refers to the scenario where there are non-genuine trust or institution that is getting approved under this automatic approval system. So to regulate this and to provide a timeline and the modalities based on which the cancellation process should take place, this amendment has been brought in. So present scenario where we saw that where a fund institution referred to in 1023C 4, 5, 6, 6A, if it is notified by the central government and such entity has not applied its income or invested or deposited its fund in accordance with the third proviso, the activities of the entity are not genuine or not being carried out in accordance with all or any of the conditions subject to which it was approved. Such entity, if it has not complied with any other law for the time being in force, then after giving an opportunity of being heard, the prescribed authority, which is the commissioner or the principal commissioner, may withdraw the approval of registration and forward a copy thereof. This was the present circumstances. This section has been replaced, and the replace clause, this is how the scenario happens, where the fund or institution referred to in 1023C, with respect to that fund or institution, the principal commissioner has noticed one or more specified violations during the previous year. How the commissioner can notice the specified violation? It can be through an anonymous letter, it can be through a newspaper report or any article which the principal commissioner or commissioner gets the notice of, or the AO can give a reference to the principal commissioner or commissioner under 143.3, and such case which has been selected with the accordance with the risk management strategy formulated by the CBDT from time to time. So these are the three modes in which the commissioner can get the information. So we also saw what is a specified violation. Specified violation means where the income of the fund, trust or institution, if it has been applied for purpose other than purpose for which it has been established, or where the income from profits and gains of the business which is not incidental to its objective, or where the separate books of accounts are not maintained by it in respect of business which is incidental to the attainment of objectives, or where the activity of the fund, trust or institution, it is not genuine or it is not being carried out in accordance with all or any of the conditions subject to it is approved, and where the fund or trust or institution has not complied with any other requirement, any other law for the time being in force or any other decree, and that that non-compliance has not been disputed or has not attained finality. In any of these circumstances, this will be regarded as a specified violation. And if there is a specified violation, then the principal commissioner or commissioner can give notice for initiate the proceedings for cancellation. And there are the section also provides that the commissioner can also accept the submissions made by the concerned trust, and if the commissioner or principal commissioner is satisfactory, then the registration need not be cancelled. So we saw how the specified violation provision operates. What is a specified date? Specified date also we saw an example whereby specified date means the day on which the period of 6 months calculated from the end of the quarter in which first notice was issued by the PCAT or CAT on or after 1st April 2022, calling for the documentation or information. So we also saw an example of what is the specified date. So we saw all this, and one of the amendments also, another amendment with respect to 1023C is that books of accounts has been prescribed by the authority. So far, the entities are required to get their books of accounts audited by an accountant referred to under section 288. The books of accounts was not prescribed by the Income Tax Act. Now, Finance Bill 2020-22 plans to prescribe the books of accounts in this regard. So this is the brief summary of what we have seen so far. So now we are starting with the balance amendments for the day. First of the amendments for the day is amendments to section 14. Section 14, before dwelling into the amendment, I would like to read out the section. So in my view, this 14B amendment is 14A, 14A amendment is a very, very crucial amendment, and it is going to have very serious implications in the times to come. 14A, expenditure incurred in relation to income which is not includable in total income. So for the purpose of computing the total income under this chapter, no deduction shall be allowed in respect of an expenditure incurred by the assessee in relation to income which does not form part of this act. The assessing officers shall determine the amount of expenditure in relation to such income which does not form part of such income according to a methodology that may be prescribed in this report. Here I would like to please observe the words, because this is going to be interpreted at a later stage. For the purpose of computing the total income under this chapter, no deduction shall be allowed in respect of expenditure incurred by the assessee in relation to income which does not form part of the total income under this act. So one of the particular references also was there. This particular clause was referred in one of the interpretations, saying that the act only referred to a situation of an assessee, an expenditure incurred by the assessee with respect to income which does not form part of the total income under this act. So I will explain the significance behind the words under this act a little later. We'll have to see what is Rule 8D. Rule 8D is this rule of method of determining the amount of expenditure in relation to income not includable in total income, where the assessing officer, having regard to the accounts of the assessee, is not satisfied with the correctness of the claim made by the assessee. The assessing officer can determine the disallowance with respect to the formula that they have specified. The formula being the aggregate of the following amounts, namely the amount of expenditure directly relating to the income which does not form part of total income, an amount equal to 1% of the annual average of the monthly average of the opening and closing balance of the PD of the investments. So this is 14A and Rule 8D. 14A came into the Income Tax Act by Finance Act 2001. It was a retrospective amendment from 1st April 1962. 14A mentions that no deduction shall be allowed in respect of expenditure incurred by the assessee in relation to income that does not form part of the total income as per the provisions of the Act. In other words, exempt income. Over the years, many disputes have arisen, because a particular example that I could say, though not recently, some 10 years before, how assessment would take place is that a company would be registered in India. It would be having a subsidiary in any foreign state, say Singapore or Malaysia, United Kingdom. So that company, the Indian company, having a wholly owned subsidiary in the foreign company, there will be transactions between the holding company and the subsidiary company for purchase of goods or purchase of goods or services, or receiving of services or entering of services. So transactions with respect to this would take place, but there would not be any dividend that would have been received from the subsidiary. In other words, the subsidiary would not have transferred any amount as dividend. The Indian company, the holding company, would not have received any amount as dividend. But at the time of assessment, what would happen is that the assessing officer would invoke the provisions of 14 and say that any expenditure incurred, for example, let us assume that Indian company had interest, they had the bank borrowings and they were paying the interest. So this interest cost incurred by the Indian company, some part of this interest cost would relate to the foreign subsidiary, and they would specifically mention that this interest cost is incurred for a future dividend income from the subsidiary, which at that point of time was exempt from tax according to the income tax. I've seen some orders whereby the interest expenditure incurred by the holding company would be worked out based on the formula specified in Rule 80, based on the opening value of the investment and closing value of investment, and an amount would be determined and addition would be made under Section 14A. Those days, what we would give as a reply is that dividend, if at all received from a foreign company, close to a point of time, it was not exempt from tax. It would be taxed at a concessional rate of 4% or 5% at that point of time. So we have not received any exempt income during the year, and hence the provisions of 14A does not apply. And there were many court decisions of many courts saying that In the absence of receipt of any exempt income in that particular year, the provisions of 14A does not apply. Does not apply. This has been an evolving matter of dispute for the past so many years. The CBDT issued a circular in 2014 stating that Rule 80 read with 14A of the Act provides for disallowance of expenditure even if the taxpayer in particular year has not earned any but exempt income. Sorry for one. This is the circular of the CBDT in 2014. Section 14A of the Income Tax Act provides for disallowance of expenditure in relation to income not included in total income. A controversy has arisen in certain cases as to whether disallowance can be made by invoking 14A of the Act, even in those cases where no income has been earned by an assessee, which has been claimed as exempt during the financial year. The matter was examined by the board, and the board came to the conclusion stating that the above position is further clarified by the usage of the term includable in the heading to 14A of the Act and also heading to the Rule 80 of the Income Tax Rules 1962, which indicates that it is not necessary that exempt income should be necessarily be included in a particular year's income for disallowance to be triggered. And also, Section 14A of the Act does not use the word income for the year, but uses the word income under the Act. This also indicates that for invoking disallowance under 14A, it is not material that the assessee should have earned such exempt income during the financial year under consideration. So, while referring to this 14A, in this 14A subsection 1, I had specifically drawn attention to this particular clause. 14A subsection 1 specifically says that for the purpose of computing total income under this chapter, no deduction shall be allowed in respect of expenditure incurred by the assessee in relation to income which does not form part of total income under this Act. This particular phrase has been referred to in that particular circular of the CBDT, which says that the words used in this context is income under the Act, and it is the words income of the year is not being used. So what the revenue contended is that even though you don't receive any exempt income, even though whether the exempt income is not accrued or not received or not deemed to have accrued, if we, in our view, if any expenditure relates to an exempt income, then the provisions of 14A would step into the picture. So this is how the assessments were going on. The explanatory memorandum specifically mentions the CBDT circular of 2014, clarifying about its stand. However, there were some courts which still took a view that if there is no exempt income during the year, no disallowance under 14A can be made for that year. So the explanatory memorandum further mentions that such an interpretation is not in line with the intention of the legislature. It also gives an example whereby a non-exempt income received for the financial year 2023 is, for example, rupees 2 lakhs. The expenditure for the non-exempt income is ₹1,50,000. The expenditure for a purported exempted income is 30,000 rupees. The exempt income for that particular year is nil. In that case, if the profit for the year, claiming the expenditure for exempt income as an expenditure would be 20,000 rupees. On the contrary, if the expenditure for exempt income is not being considered, the profit for the year would be 50,000 rupees. So this is the particular scenario which the explanatory memorandum talks about, which says that by allowing the expenditure for exempt income as an deduction, even though there is claiming that there is no exempt income received during the year, the tax, the amount of profit to that extent comes down. Accordingly, tax to that extent comes down. By holding that the provisions of Section 14A does not apply in case of non-received or non-accrual of exempt income during, it amounts to allowing rather 30,000 as expenditure for non-exempt income, even though the said sum was not incurred wholly and exclusive for the purpose of earning non-exempt income. Such an interpretation would defeat the legislative intent of 14A and 37 of the Act. So in order to make the intention of the legislation very clear, and in order to make it free from any misinterpretation, it is proposed to insert an explanation to 14A of the Act to clarify that, notwithstanding anything to the contrary contained in this Act, the provisions of this section shall apply and shall be deemed to have always applied in a case where exempt income has not accrued or arisen or has not been received during the previous year relevant to assessment year, and the expenditure has been incurred during the previous year in relation to such income. It is also proposed to amend the subsection 1 so as to introduce a non-obstant clause in respect of the other provisions of the Act. So what is the amendment that they have made? In subsection 1, as you can see, the subsection 1 at present starts with the word for the purpose of computing the total income under this chapter. It does not have any non-obstant clause. Now, with this amendment, a non-obstant clause is being introduced. Now, notwithstanding anything to the contrary contained in this Act, for the purposes of computing the total income under this chapter, no deduction shall be allowed in respect of expenditure incurred by the assessee in relation to income which does not form part of the total income under this Act. So the first subsection 1 makes it very, very clear that notwithstanding anything contrary contained in this Act, any expenditure, if it relates to any exempt income, that expenditure would not be allowed as a deduction. This very much fortifies the lawmakers' stand that the lawmakers again they want to be double clear with respect to this stand, stating that in future anything that pertains to an exempt income, irrespective of the fact that it is received or deemed to be, irrespective of the fact whether it is received or not, whether it is deemed to be received or not, it will be taxable. And they want to make it even more clear by adding the following explanation. After the proviso, the following explanation shall be inserted. The explanation says that for the removal of doubts, it is hereby clarified that notwithstanding anything to the contrary contained in this Act. Again, a non-obstant clause for an explanation. So already we have subsection 1 which is amended with a non-obstant clause, which makes it amply clear that 14A would operate even when there is non-receipt of exempt income, non-receipt of any purported exempt income. This explanation, it further fortifies the stand by saying that for the removal of doubt, it is hereby clarified that notwithstanding anything to the contrary contained in this Act, the provisions of this section shall apply and shall be deemed to have always been applied in a case where the income not forming part of total income under this Act has not accrued, has not arisen, or has not been received during the previous year relevant to assessment year, and the expenditure has been incurred during the said previous year in relation to such income not forming part of the total income. So at the cost of repetition, I would like to say that this explanation, again, it is clarifying all the potential doubts. This language, particular language, that it has not accrued or not arisen or has not been received, in my view, it is very own to the Indian Income Tax Act, because this is one different kind of an elegant phrase which says that irrespective of whatever may be the scenario, we can claim that it has not accrued, it has not arisen, or has not been received, 14A would operate. There are many, with this amendment, many decisions of the courts have been overruled. Some of the judicial pronouncements that have been overruled with these amendments are Chettinad Logistics Private Limited with the CAT decision of the Madras High Court 248 Taxman 55, GVK Projects and Technical Services Limited CAT 106 Taxman.com 180. So this 14A amendment is very, very crucial amendment. Going forward, while finalizing the audits of the companies, or the assessees rather, we will have to again invoke the provisions of 14A, and we will have to be very, very cautious as to whether any of the expenditure that the assessee has incurred, whether it might lead to receipt of an exempt income in the future. If that is the case, a disallowance has to be worked out and done today. And otherwise, going forward at the time of assessments, definitely I see this 14A being invoked with much more vigor and much more consistency by the department, stating that this particular expenditure would definitely lead to this particular exempt income. So this is the amendment with respect to 14E. The next of the amendment is amendment of section 17. Section 17 largely this amendment relates to exemption of amount received for medical treatment on account of death due to the COVID-19 pandemic. This is a retrospective amendment with retrospective effect from 1st April 2020 and will apply from assessment year 2020-2021 onwards. Reference to the explanatory memorandum. Section 17(2) of the Act provides a definition of perquisite. However, certain exceptions have been provided which shall not be considered as perquisites. The Finance Ministry has released a press statement dated 25th June 2021, where it was announced that the income tax shall not be charged on the amount received by a taxpayer for medical treatment from employer or from any other person for treatment of COVID-19 during financial year 2020 and subsequent years. It was further announced that in order to provide relief to the family members of such taxpayer, income tax exemption shall be provided to ex gratia payment received by the family members of a person from the employer of such person or from other person on the death of the person on account of COVID-19 during financial 2020 and subsequent years. Also, it was stated that the exemption shall be allowed without any limit for the amount received from the employer, and the exemption shall be limited to rupees 10 lakhs in aggregate for the amount received from any other persons. In order to provide the relief stated in the particular press statement in 2021, it is proposed to amend section 17(2) to insert a new clause in the provisos to state that any sum paid by the employer in respect of any expenditure actually incurred by the employee on his medical treatment or treatment of any of the member of his family in respect of any illness related to COVID-19, subject to conditions as may be specified by the central government, the same shall not be forming part of the definition of the perquisite. Further, it is proposed to provide that for the purpose of both of the said clauses, family in relation to an individual shall have the same meaning as assigned to it in the explanation 1 to clause 5 of section 10. I will take you to section 17. This is the clause that they are talking about. Provided that nothing contained in this clause shall apply to, these are the existing exclusions from the meaning of perquisite. Any medical treatment provided to an employee by the member of his or any member of his family in a hospital maintained by their employer. So, if the employee gets any medical treatment for him or her along with the family members in any hospital maintained by that employer, it will not be regarded as a perquisite. And any sum paid by the employer in respect of any expenditure actually incurred by the employee on his medical treatment of his member of his family in an hospital maintained by the government or any local authority or in respect of the prescribed diseases was also not regarded as a perquisite. In this clause, now one another amendment is being added, and this is the clause that is getting added to that cluster. In respect of any illness relating to COVID-19, subject to conditions as the central government may by notification in the official gazette specify in this behalf. So, in my view, if you could read this proviso, this projects a trend as to getting a medical treatment in an hospital. So, in that hospital can be an hospital maintained by the employer, or it can be an hospital of the government or the private sector, subject to the conditions. Now, this amendment with respect to COVID, in respect of any illness relating to COVID-19, subject to such conditions as the central government may by notification in the official gazette specify in this behalf. Treatment with respect to COVID can be hospital-based treatment or a home-based treatment, or it can be Ayurvedic treatment, or broadly of these three types. So we will have to wait and see as to what are the conditions that the central government may prescribe in this regard. And basically, this is the conditions that would determine whether what is the actual quantum of medical expenditure that would be exempt from tax. So we'll have to wait and see for what is the notification that the central government is giving with respect to claiming of benefit under this act. However, this is a retrospective amendment. Since this being a retrospective amendment, financial year 2021 income tax return, by finalizing the income tax return, this benefit I hope it would have been claimed. And for this financial year 21-22, assuming that the government comes out with the notification in the times to come, while finalizing the financial returns for financial year 21-22, in the applicable cases, the benefit can be claimed in the applicable cases. Then the next amendment is amendment of section 35. This is again a retrospective amendment with effect from 1st April 2021. Reference to the explanatory memorandum. Section 35(1)(a) of the Act was inserted by the Taxation and Other Laws, Relaxation and Amendment of Certain Provisions Act 2020, with effect from 1st April 2021. It mandated the research association, university, college, or other institution referred to in clause 2 or clause 3, or the company referred to in clause A of 35(1) to file the statement of donation received by these entities from the donors. However, an inadvertent drafting error are kept in that subsection. The present subsection, the language of the present subsection reads that no deduction shall be allowed to the research institution or university or college if such statement of donation is not filed. In other words, it is telling that the recipient would not be given a deduction if a statement of donation is not being filed. There is a drafting error that has crept up. The explanatory memorandum acknowledges that drafting error, saying that the same is not the intention of the law. This amendment is made to correct the inadvertence. So the section 35(1)A has been suitably amended to provide that deduction claimed by the donor shall be disallowed unless such research association, university, college, or other institution or company files the statement of donation. This inadvertent mistake has been rectified with this Finance Bill 2022. The next amendment is amendment of section 37. Section 37 and section 40, that is coming after section 37. In my view, these two amendments are very, very crucial amendments again. And the explanatory memorandum has given wonderful reasons. According to me, it has given wonderful detailed reasons as to why this amendment has taken place. And in fact, in one of the sections between 37 and 40, in section 37, it talks about nearly as to close to 5 judgments which held that this is sections of the provisions of section 37 is not applicable. The provisions of section 37 is applicable. So it refers to the judgments which was favorable to the revenue, which is favorable to the department. And in amendment to section 40, the explanatory memorandum goes to 1st April 1967. So there's a CBDT circular which goes way back to 1st April 1967, and it covers the reasons in such a way. So I would like to present the explanatory memorandum as it is to all of you, because in my view it is a detailed explanation that has been given, and this will be having impact in all the cases that practically we see. So this is the reference to the explanatory memorandum. Section 37 of the Act provides for allowability of revenue and non-personal expenditure other than those falling under sections 32, 30, 36, laid out or expended wholly and exclusively for the purpose of business or profession. Explanation 1 to 37(1) of the Act provides that if any expenditure incurred by the assessee for any purpose which is an offence or is prohibited by law shall not be deemed to have been incurred for the purpose of business or profession, and no deduction or allowance shall be made in respect of the such expenditure. This particular amendment is largely relating to the reasons stated in the explanatory memorandum is largely related to the pharmaceutical sector. The explanatory memorandum further mentions that, however, it is seen that certain taxpayers are claiming deductions on expenditure incurred in offering certain benefits or purposes to a person which are not intended to be allowed under this section, like meetings expenditure related to travel, hospitality, conference. In such cases, acceptance of such benefit or pursued by such a person is in violation of law, or rule, or regulation or guidelines, as the case may be, governing the conduct of such person. The CBDT, they had given a circular in 2012, dated 1st August 2012, CBDT Circular 5 of 2012. I have the circular for your reference. This particular circular of the CBDT, it talks about inadmissibility of expenditure incurred in providing freebies to medical practitioner by pharmaceutical and allied health sector industry. So this is the particular circular, which says that it has been brought to the notice of the board that some pharmaceutical and allied health sector industries are providing freebies to medical practitioners and their professional association in violation of the regulations issued by the Medical Council of India. Section 37 of the Income Tax Act provides for deduction of any revenue expenditure from business income if such expenditure is laid out wholly and exclusively for the purpose of the business or profession. However, the explanation added to this subsection denies the claim of such expenditure if the same has been incurred for a purpose which is either an offence or prohibited by law. Thus, the claim of any expenditure incurred in providing the above mentioned or similar freebies, if it is in violation of the Indian Medical Council regulations, the same shall be inadmissible under section 37 of the Income Tax Act, being an expense prohibited by law. This disallowance shall be made in the hands of such pharmaceutical or allied health sector industries or other assessees which has provided the aforesaid freebies and claimed this as a deductible expense in its accounts against the income. It is also clarified that some equivalent to the value of freebies enjoyed by the aforesaid medical practitioner or professional association is also taxable as business income or income from other sources, as the case may be, depending on facts of each case. The assessing officer or such medical practitioner or professional association should examine the same and take appropriate action. So this is the CBDT circular of 5/2012. A brief background as to what the CBDT circular intends to cover is that, again, this is mainly relating to the pharmaceutical sector, whereby the pharma companies representative would go to the doctor and they would give free samples to the doctor, and sometimes commission also would be given, and the Indian Medical Council's guidelines at some stage prohibit the concerned medical professional from receiving some commissions or freebies. The explanatory memorandum is specific in this regard. CBDT circular wide 5/2012 dated 1st August 2012 noted that Indian Medical Council, in excess of its statutory powers, amended the Indian Medical Council regulations, imposing on prohibition on the medical practitioner and their professional association from taking any gift, travel facility, hospitality, cash or monetary grant from pharmaceutical and other health sector industries. Accordingly, the CBDT clarified that the claim of any expenditure incurred in providing above mentioned or similar benefits in violation of the Indian Medical Council guidelines, and the same shall be inadmissible under Section 37(1) of the Act. This disallowance was directed to be made in the hands of the pharmaceutical companies or allied institute or the allied health sector industries. The validity of this circular was challenged before the Himachal Pradesh High Court in the case of Confederation of Indian Pharmaceutical Industry versus the Central Board of Direct Taxes, where the Honorable Himachal Pradesh High Court held that the regulation of the Medical Council prohibiting the medical practitioners from availing freebies is a very salutary regulation which is in the interest of the public. The court is not oblivious to the increasing complaints that medical practitioners do not prescribe generic medicine and prescribe branded medicines only in lieu of the gifts. So the court further mentioned that if this has been prohibited by the Indian Medical Council under the powers vested in it in Section 37, then the provisions of Section 37 would come into play. So the Himachal Pradesh High Court mentioned that the circular is very much valid in law, and in the specified circumstances, any gift or freebies given by the pharmaceutical companies to the doctors, to that extent it is prohibited by the Indian Medical Council, it will not be allowed as an expenditure in the hands of the pharmaceutical company or the medical or the other medicine or the other business entity. There are decisions, even after this decision, there are decisions that have been contrary to this judgment, and whereby some of the judgments have held that these expenditure to some of the judgments have held that these expenditure are allowable by saying that the regulations of the Indian Medical Council applies only to the doctors and it does not apply to the pharmaceutical companies that are governed in this. So the latest of the decisions, according to the explanatory memorandum, which is the decision in the case of Masilite Pharmaceuticals delivered on 14th October 2021, where the ITAT Mumbai has held that the assessing officer disallowing the expenditure under Section 37 in the circumstances, it is a correct decision by the assessing officer to disallow the same. The ITAT in this regard ruled the case in favor of the department, and while arriving at this particular decision, they again referred to the decision of the Supreme Court in Keshavji Rajvi case of 1990, and whereby they also introduced the philosophy of interpretation, saying that the Himachal Pradesh High Court has given a particular decision stating that in the context of Section 37 read by the Medical Council of India's guidelines, any freebies given to the doctors and any commission given to the doctors in this regard, to that extent it is not allowed. It is not to be allowed as an expenditure. But there are other tribunal decisions which say that the freebies and all these regulations will apply only to the doctors concerned, and it will not apply to the pharmaceutical companies concerned in this regard. So this particular ITAT Mumbai decision in the case of Maselite Pharmaceuticals, it mentions that being the Himachal Pradesh High Court being a higher authority than the higher judicial forum than the income tax appellate tribunals, the decision of the Himachal Pradesh High Court in this regard would prevail. And it goes on to explain in detail about each and every contrary decisions. They also refer to the case of DCAT versus PHL Pharma, where it was held that the disallowance could not be sustained as per the NCA guidelines, find only the medical professionals and not the pharmaceutical companies. So the reference has been made to lot many decisions, and these are the decisions that are captured by the explanatory memorandum. So time permitting, if I would try to lead this, but in light of the other provisions, I'm just scrolling through this. I request each and everyone to find time to read this particular part in the explanatory memorandum, which has been drafted, in my view, very well. So citing all this recommendations, citing all these views, the explanatory memorandum makes one position very clear. Thus, the legal position is clear that claim of any expense incurred in providing various benefits in violation of the provisions of the Indian Medical Council, Professional Conduct, Etiquette and Ethics Regulation 2002 shall be inadmissible under subsection 1 of 37 of the Act, being an expense prohibited by the law. And there are contrary decisions that has been cited here. The explanatory memorandum further mentions that some taxpayers are seen to be claiming deduction on expenses incurred for a purpose which is an offence under foreign law or compounding of an offence for violation of foreign law, claiming that the provisions of explanation 1 applies only to offences which are prohibited by the domestic law of the country. In some cases, this view also has been accepted by the tribunal. These judgments are also against the intention of the legislation, and the legislation does not say that explanation 1 applies to only violation of domestic law. So, in order to make the intention of the lawmakers very clear, the following amendments are proposed to section 37. So, what are the amendments that are proposed to section 37? Explanation 3 has been inserted, stating the following. Sorry, I would like to confirm whether it's a prospective or retrospective amendment. This amendment applies from 1st April 2022. Explanation 3 has been inserted, stating the following. For the removal of doubts, it is hereby clarified that the expression expenditure incurred by an assessee for any purpose which is an offence or which is prohibited by law under explanation 1 shall include and shall be deemed to have always included the expenditure incurred by an assessee for any purpose which is an offence under or which is prohibited by any law for the time being in force in India or outside India. This particular limb, it opens up so many questions in this regard. For any purpose which is an offence under or is prohibited by any law for the time being in force in India or outside India. So, while certifying my tax audit report, I would have to consider what are the laws that is applicable in India and what are all the laws that is applicable outside India for the Indian entity. For example, an Indian entity might have some business outside India. There, under that particular act of that foreign country, they would have committed a violation. And for that violation, a compensatory interest or a compensatory damage would have been levied by that act. So I will have to get the knowledge of that particular act, and according to the language of this explanation, that compensatory damage that an entity pays to the authority of the foreign country under that foreign act or pronouncement, that also would be regarded as an offense, and that expenditure also would not be allowed. In my view, this is an amendment that is having very serious implications, because first I should understand what is the laws applicable to the particular entity, laws applicable in India to that particular entity. Then I will have to ascertain what are the laws applicable to that entity outside India, and we'll have to have knowledge of all this, and further our audit has to the scope of our audit has to enhance to find out whether that particular expenditure, it is for an offense which is outside India. Then after analyzing from all these perspectives, then we'll have to take a decision whether that particular expenditure is an allowable expenditure under section 37 or not, and accordingly we'll have to mention it in the tax audit report, disallow it, and file the income tax return. Of course, there will be some content. This, in my view, would be having serious implications where, in the example that I mentioned, a compensatory damage that is being paid outside India, if that is also regarded as an offense, and to that extent, if it is not going to be, if it is going to be disallowed, then it will be of very greater consequence to the business entity concerned. So this is the one particular limb that has been added by the explanation. The next limb is that, and this is the limb that pertains to the pharmaceutical sector in the explanatory memorandum. The next purpose is to provide for any benefit or perquisite in whatever form to a person, whether or not carrying on a business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law, rule, or regulation or guidance, as the case may be, for the time being in force, governing the conduct of such person. The explanatory memorandum refers to the pharmaceutical industry as a reason for this particular amendment. In my view, this particular amendment does not apply only to the pharmaceutical industry. It applies to all the industries whereby the particular assessee, being a company or a non-corporate form of an entity, if it directly or indirectly deals with the employees of the government. For example, government servants in service, they are prohibited from receiving any commission or gifts. Government servants after service, after retirement, some of them are consultant to some companies. We don't know at all times that what are the regulations that is governing under each of the government servants' scope of work. So in this scenario, there may be circumstances where in any, not only in this medical field, it can be related to a road construction industry also, where the NHA officers' approval is required for certain activities in the conducting of certain activities in the road construction. So any gift or any gift made to that NHA authority by a company, if at all any gift is made, that would also, if that is violated by, that is in prohibition by the guidelines of the NHA, for example, that would also be regarded as an offense, and to that extent, benefit of the same, the expenditure benefit of the same would not be available. So this applies to not only gift, it is such benefit or perquisite. So it can be anything. So to be very candid, can be even cash or anything value equal to cash, anything that goes by the definition of the perquisite. If that is in violation of any particular law or rule, as the case may be, then that would also be not allowed as an expenditure. One particular aspect that I wanted to highlight in this regard, this particular expenditure is disallowed in the hands of the company or the business entity. Whether the recipient is liable to pay tax on the same, in my view, yes, the recipient is also liable to pay tax on the same, irrespective of whether the recipient is carrying on business or profession, because this particular explanation says it categorically. It says that to provide any benefit or perquisite in whatever form to a person, whether or not carrying on a business or whether or not exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law or rule or regulation or guidance, as the case may be, for the time being in force governing the conduct of such person. So this this again is a very serious amendment that can have so many interpretations in the times to come. The next of the limb in this particular explanation is to compound an offense under any other law for the time being in force in India or outside India. In other words, any expenditure incurred for compounding an offense under the law for the time being in force in India or outside India, if that for compounding of that offense, if compounding fee is paid, that compounding fee also would be disallowed under section 37. So just to give a numerical perspective, numerical example, an assessee has filed the income tax return, and upon scrutiny, the officer says that one particular income has not been disclosed in the income tax return. So on account of some variance or something, the income tax return income is in the assessment, the income is being enhanced. So because of non-disclosure of income, a penalty is being levied by the assessing officer. And let's assume that the assessee pays the penalty. Once the penalty is being paid, prosecutions parallelly starts to happen. So prosecution proceedings, if it starts to happen, broadly the prosecution proceedings would relate to either imprisonment or facing the proceedings in the court. So what generally happens is that if the prosecution is not an option, the other option that is available to the assessee concerned is getting the offence compounded under the Income Tax Act. So for compounding, there is a separate set of rules and regulations, as everyone knows. And for compounding, there is a specific fee that is being applicable, that is being charged, and that fee is worked out based on the quantum of income that has escaped the tax and the quantum of penalty and everything. The computation matrix, all in that section, I'm not discussing about that. But there is a manner in which the compounding fee is being worked out, and that particular assessee would pays the compounding fee, gets the offence compounded. That compounding fee, for example, if it is 10 lakhs or 15 lakhs, if I want to give, if I can give a number to it, that 10 or 15 lakhs, if it is a business entity, that 10 or 15 lakhs also would not be allowed as an expenditure. So the penalty that is being paid, that cannot be claimed as an expenditure. So instead of the prosecution proceedings, the assessee opts for the compounding. The compounding fees that the assessee pays, that also would not be claimed as an expenditure. This is compounding of an offence under Income Tax Act. For example, if there is a violation under FEMA, and if if the company gets the offence compounded under FEMA, that compounding fee also would not be allowed as an expenditure under the Income Tax Act. And this would apply to compounding fees paid outside India also. So in one of the earlier examples, I said that a compensatory interest paid under a foreign act, that also is disallowed under section 37. The same way, any amount paid for compounding an offence under the laws of a foreign country, that also would be disallowed under section 37. So this is the amendment relating to section 37. At the cost of repetition, this is a very serious amendment which having great implications. And in my view, in future we can see lot many litigations would come. Again, there would be many decisions which would say that this is not an offence and this can be allowed. In future, we can see lot many contrary views. I mean, we can see decisions which favor the assessee in this regard, and we'll have to wait and see how this particular amendments plays out in the times to come. The next of the amendment, this is amendment of section 40, clarification regarding treatment of cess and surcharge. This is a retrospective amendment from 1st April 2005 and will apply from assessment year 5, 6 and subsequent assessment years. The background of this is section 40 specifically mentions that any sum paid on account of rate or tax shall not be deducted in computing the income chargeable under PGP. The word mentioned here is rate or tax. However, certain taxpayers are claiming the deduction on account of cess or surcharge under section 40 of the Act, claiming that cess has not been specifically mentioned in the provisions of 40A2 and therefore cess is an allowable expenditure. This view has been upheld by the courts in many judgments. Further, the courts are relying upon the circular of CBDT in 1967. This is the circular that I was mentioning. Unfortunately, I couldn't get this circular of CBDT of 1967, but based on what is available in the internet, the CBDT circular of 1967 specifically mentions that the word surcharge and cess, they explain about that. They basically say that surcharge is an additional tax and cess is sometimes cess is not related to word tax. Cess is a different purpose or a different, altogether it is a different purpose, and cess is levied for a specific purpose. And the CBDT circular explains about what is a cess and what is a tax, what is a surcharge. The explanatory memorandum further mentions that the assessees rely upon the decision of the Honorable Bombay High Court in the case of Sesagova Limited versus JCIT, and further there's a decision of Honorable Rajasthan High Court in case of Chambal Fertilizers and Chemicals, wherein the Honorable High Courts have relied upon the CBDT circular of 1967. And in the view of the interpretation made to the CBDT, they have held that education cess can be claimed as an allowable deduction while computing the income chargeable under the heads profit and gains from business or profession. Based on these decisions, ITAT in various judgments have followed the same reasoning and have allowed deduction on account of payment of cess. However, one of the latest judgment of ITAT Kolkata, it has discussed the two High Court judgments as well as other judgments, as well as the other judgments in this case of Kanoria Chemical Industries, and has held that the cess is not allowed as a deduction. In the above referred circular issued by the CBDT, cess is to be allowed under subclause 2 of 40 clause A to the Income Tax Act. However, it is to be noted that a cess is imposed not only by the central government through the Finance Act for a particular financial year, but also by the various state governments. It is pertinent to mention that in the above referred circular of the CBDT of the 1967 circular, there is no reference to the cess imposed by the central government through Finance Act for a particular year. This CBDT circular needs to be seen from the perspective that education cess imposed by the Finance Act 2004 and the subsequent acts, and then this education cess was redesignated as education and health cess, are actually tax in the form of additional surcharge as stated clearly in each of the relevant Finance Act. The decisions of the Rajasthan High Court and the Bombay High Court did not consider the judgment of the Honorable Supreme Court discussed about. The Supreme Court in the case of Supreme Court. The Supreme Court in this case of CAT versus Grace Srinivasan, it is the Supreme Court's decision that held that the circular of CBDT circular of 1967 is in correct perspective, and they held that cess is not an allowable expenditure. The explanatory memorandum refers to that particular decision of the Supreme Court and further says that the judgments of the Rajasthan High Court and Bombay High Court, which allowed the cess to be an expenditure, it did not consider the judgment of Honorable Supreme Court in CAT versus Srivastava. And these judgments of these two high courts, which says that cess is to be claimed as an expenditure, appears to be per incuriam. Per incuriam means refers to the judgment of a court which has been decided without reference to a statutory provision or earlier judgments which could have been relevant. From above discussions, it may be seen that the interpretations of the two high courts and the various income tax appellate tribunals are against the intention of the legislature, and it is not in line with the judgment of the Honorable Supreme Court. Hence, in order to make the intention of the legislature very clear and to make it free from any misinterpretation, it is proposed to include an explanation retrospectively in the Act itself to clarify that for the purpose of this clause, the term tax includes and shall always deem to have included any surcharge or cess by whatever name called on such tax. So explanation 3 has been inserted and shall be deemed to have been inserted with effect from 1st April 2005. This is the explanation 3. For the removal of doubt, it is hereby clarified that for the purpose of this clause, the term tax shall include and shall be deemed to have always included any surcharge or cess by whatever name called on such tax. So basically, any surcharge or cess that is being paid by the assessee, it will not be allowed as an expenditure. So what are the cesses that some of the cesses that are applicable in India? Some of the cesses that are at present prevalent is an infrastructure cess. So what is an infrastructure cess? Cess that is levied by the central government on vehicle mass productions. It ranges from 1 to 4% based on categories of vehicle. There is one another cess called as agriculture, infrastructure and development cess, a tax that the government imposes on commercial production of agricultural produce. There is one other cess that is called as Building and Other Construction Workers Welfare Cess Act, a cess on the cost of construction incurred by the employees. In addition to this, there are some cess that is being imposed by the state government. Just numerical example for this cess. For example, this Building and Other Construction Workers Welfare Cess Act. Construction companies, for example, I'll take example of road construction. Road construction project, it's basically any road construction project would take 3 to 5 years. And for example, that's project. Let's assume that the project cost is 300 to 500 crores. We'll assume it to be 300 crores. So this takes at least 3 to 5 years for the road to get constructed, be it a state highway or a national highway. That particular company engaged in construction of that particular road, they will have to provide for the Building and Other Construction Workers Welfare Cess Act. So what is the actual cost of construction incurred in that particular year? A percentage of that construction cost would have to be paid by the company as Building and Other Construction Workers Welfare Cess Act. For example, if the cost incurred for that particular year is 50 crores, 1% of that 50 crores would be paid as the Building and Other Construction Workers Welfare Cess Act. So this cess that the company incurs, according to the language of this section, it would not be allowable as an expenditure. So again, this amendment would increase the tax outflow of the companies who are paying cess on account of their business activities. Because not only this Construction Workers Welfare Cess Act, there are other state government cess that applies to each and every entity depending upon the nature of the business. So if the cesses that they pay, if that is going to be disallowed, that would definitely increase the tax effect of those companies. And one particular aspect that I wanted to give more emphasis in this regard is this particular amendment is with retrospective effect from 1st April 2005. So from 1st April, with a retrospective effect from 1st April 2005, any cess or surcharge, if it is claimed as an expenditure, that would be disallowed under section 40. So if there are any pending assessment proceedings that is pending as of now, definitely this amendment being retrospective, this should be considered by the Income Tax Department while framing that, while conducting the case. And for any ongoing assessments, the retrospective amendment would have an effect. And under 154, subject to the provisions of section 154, under rectification provisions, the officer might issue a notice stating that any claim of the cess or tax, any claim of the cess or surcharge in one of the earlier years, it would not be regarded as a deduction. That is possible. And the commissioner under 263 under revisionary powers, the commissioner or the principal commissioner can also issue a notice stating that to that extent order of the assessing officer is erroneous and prejudicial to the interest of the revenue. So these are the avenues whereby, since this being a retrospective amendment, for ongoing assessment proceedings, this will have an impact. Under 154, notices can come citing this particular issue. The commissioner can also invoke the cases under 263, saying that it is erroneous and prejudicial to the interest of the revenue, because this being a retrospective amendment. So this is one particular implication of this amendment. Going forward, while conducting our audits and while closing our audits, we will have to be double careful, I would say, in ensuring that cess any items in the nature of cess or surcharge that should be disallowed under the provisions of section 40. So this is the amendment with respect to cess, section 40. The next amendment is amendment of 43B. Actually, this amendment is a very short amendment. The explanatory memorandum gives very short reasons for this amendment. Clarification regarding deduction on payment of interest only on actual payment. The explanatory memorandum, reference to the explanatory memorandum. Section 43B of the Act provides for certain deductions to be allowed only on actual payment. Explanation 3C, 3CA, and 3D of this section provides that A deduction of any sum being interest payable on loan or borrowing from specified financial institution, NBFC, scheduled bank, or a cooperative bank under Clause D, Clause DA, Clause E of this section respectively shall be allowed if such interest has been actually paid and any interest referred to these clauses has been converted into a loan or borrowing on advance shall not be deemed to have been actually paid. However, certain taxpayers are claiming deduction under 43B on account of conversion of interest payable on an existing loan into a debenture on the ground that such conversion is a constructive discharge of interest liability and therefore amounted to actual payment, which has been upheld by several courts. Such interpretation is against the intent of the legislation. This section was introduced to curb the mischief of claiming deduction by the assessee without paying interest to the financial institution, NBFC, scheduled bank, or cooperative bank. Section 43B makes a departure from other sections in the Act as indicated by its non-obstant clause. Under the provisions of this section, conversion of an outstanding interest liability into debentures is not an actual payment and cannot be claimed as a deduction. In other words, a mercantile system of accounting cannot be looked at when a deduction is claimed under this section as actual payment would have to be made. This amendment is proposed in light of the above. So, in short, what this amendment tries to make is that interest as a deduction is available under 43B Act subject to actual payment. This is the bare provisions of 43B. There are circumstances whereby the particular loan is being converted as a debenture. And upon conversion of the loan as a debenture, one part of the interest is actually not getting paid and it is getting converted as a debenture. So, to that extent, that amount being unpaid, it is contrary to the provisions of 43B, which mandates that deduction is available only upon payment. And there have been many decisions of the court saying that this is an allowable expenditure because it is converted as a debenture and it is effectively taking its place into the debenture. So, it is a payment for the purpose of 43B. But the lawmakers wanted to be very clear in this, stating that such an interpretation is against the intent of the legislation. The section was introduced to curb the mischief of claiming deduction by the assessee without paying interest to the financial institutions, NBFC, scheduled bank, or cooperative bank. So, under the provisions of this section, conversion of the outstanding interest liability to debentures is not an actual payment and cannot be claimed as a deduction. In other words, the mercantile system of accounting cannot be looked at when a deduction is claimed under this section as actual payment would have to be made. The amendment is proposed in light of the above. What is the amendment? The words debenture or any other instrument by which the liability to pay is deferred to a future date. That set of words has been inserted at appropriate places in explanation 3C, 3CA, and 3D. I would like to show what is the explanation 3C, 3CA. Explanation 3C. For the removal of doubt, it is hereby clarified that the deduction of any sum being interest payable under clause D of this section shall be allowed if such interest has been actually paid and any interest referred to this clause has been converted into loan or borrowing shall not be deemed to have been actually paid. Explanation 3CA also says that for the removal of doubt, it is hereby declared that the deduction of any sum being interest payable under clause DA shall be allowed if such interest has been actually paid and any interest referred to in that clause which has been converted into a loan or borrowing shall not be deemed to have been actually paid. And explanation 3D also talks about the same in a different context, saying that any interest referred to in that clause which has been converted into a loan or advance shall not be deemed to have been actually paid. Now, in this explanation 3CA, 3D, and 3C, the words debenture or any other instrument by which the liability to pay is referred to a future date is added. So, in other words, in all these explanations, along with the existing borrowing, the words debenture or any other instrument by which the liability to pay is deferred to a future date, it is being added. So it can be a loan, it can be a borrowing, it can be an advance, or it can be a debenture or any other instrument by which the liability is to pay is deferred to a due date, deferred to a future date. So this is the amendment to 43B extension 3C, 3C, and 3D. This amendment specifically nullifies the Supreme Court decision in this context. I'll share the decision of the Supreme Court subsequently. But the phrase that the lawmakers choose to use in this context is they are adding the words debenture or any other instrument by which the liability to pay is deferred to a future date. So by this, the lawmakers, they want to clearly demarcate a definition saying that it can be a loan, it can be an advance, it can be a debenture or any other instrument by which the liability to pay is deferred to a future date. So by giving specific reference to loan, advance, debenture, whether the law is trying to specifically mention that a loan is different, interest is different, debenture is different. If yes, if we have to consider these three terminologies to be different, then in my view, this particular amendment does not restrict itself here. For example, there are places where this loan or borrowing, other sections related to this loan or borrowing, for example, 222 deemed dividend, where a loan or advance to the particular directors is regarded as deemed dividend. For example, instead of giving us loan and advance, if the company gives a debenture to that particular director, so whether the debenture is, if it is held that debenture is different from a loan or a borrowing, then in 222E we are talking about only a loan or an advance. So this leads to some misinterpretations in other sections of the Act. In this section, yes, the law says that loan is different, borrowing is different, debentures are different. So whether this same principle has to be applied in 222E or whether the same principle has to be applied in 269 SS, 269 ST, 269T, whereby this loan or advance word is being used. So here, if a particular specific exclusive definition is being drafted, whether this inference of this particular definition can be imputed to other sections like 222E, 269S, 269 SS, 269T, well, this is a question that we'll have to wait for the future to give an answer. In my view, again, this very subtle amendment can lead to many different interpretations. And in my view, I foresee many litigations in this context whereby this particular clause can be taken as base for a dispute, wherein stating that the Income Tax Act in this particular section treats debenture different, treats loan as a different product, advance as a different product, and debenture as a different product. But the same meaning is not imputed in 222E, 269S, and 269T. So this is one particular interpretation issue that might come in this regard. So this is the amendment to section 43B. With this, I've finished presenting the content for the day. The floor is open to questions.
One second, sir. There's no question, I think. Any other question from members? Sorry. Is it really the clarification? Sir, I think so. No clarification from the members. It's a really wonderful session. So like we're just starting from like crypto, and then you're just passing to like each and every item twice, one by one, discussing that you're just going in depth of the topic like 43B and other topic like about the sales and 14A sections and all. It's really just going through completely about like we recollecting everything like what is the need of this amendment and what is the requirement and each and every depth of the act. I think so. I think everyone has enjoyed this session. It's really like this 4-day series. That is tomorrow. This last day series, and we really there is on this particular it's like a course. I feel like we will it's like a course we enjoyed, and I think it's really comfortable. Fine, so
Thank you.
we thanks for this your wonderful session, and I request now MGB sir to give vote of thanks and just give some comment about this and just close the session. Thank you, sir.
Thank you, sir. Thank you, sir. Vivek sir, you have given a very elaborate the details about the amendments in the provisions of the Act. Especially, you have given abundant caution to members and about the ramifications of these retrospective amendments. And I think we have more opportunities in the future by way of litigations and as well as these notices being received. That is good. And as well as this 43B and especially this interest. This is the need of the hour due to this COVID. Many of the companies and many of the individuals also, they have gone for a restructuring of the loan, wherein they have not paid the interest and moratorium period had been given. So, but at the same time, they made some kind of a restructure, as you said, somebody would have converted as a debenture or whatever. But those cases where you have thrown a deep dive and you have made a deep dive and thrown a light on that those interest, whatever restructured, cannot be claimed now as an expenditure under the 43B as per this amendment, which is very clearly mentioned. Of course, there is no any ambiguity now because of this explanation 3 and as well as 3A. Thank you, sir. And on behalf, of course, tomorrow is the last session. And as Yomuti said, we feel like it is a refreshing course only rather than as a session. We are recollecting because this is one of the opportunities for us to refresh ourselves. Thank you, sir. Thanks for this opportunity.
Thank you, sir. Thank you. Thank you.
On behalf of Chengalpattu branch of SARC of ICA and as well as on behalf of MC team, I really thank you to the speaker and as well as to the members for their patient listening. And tomorrow we will meet with the part 5, the last session. So we will have more insight on the amendments. Thank you, sir.
Thank you, sir. Thank you. Thank you.
Thank you, sir.
Thank you, sir. Thank you. Thank you.
Madam. Indu, madam. One second. Anna, real section is going good, sir. Like in depth topic, everything. It's like, madam, I do panic. Close. Right. One nimsham.
Thank you.
Two problems function actually like that is right. So fine, madam. You can do in, madam.
Thank you.
Sir, close பண்ணிடவா?
Close பண்ணிக்கலாம், madam.
Okay. Thank you, sir.
Thank you, sir.
Madam. Thank you, sir. Thank you.